Okay, Petroleum Industry Act. This is an act that was enacted in year 2021. If I'm not mistaken, it became effective in year 2022. Became effective in year 2022. And the essence of the act is to regulate the activities of petroleum industry. Is to regulate the activities of companies engaged in the petroleum industry. So, as we all know, whether we like it or not, for a while now, for donkey years now, oil has been one of the major sources. Even if I'm not mistaken, it's still the major source of revenue for government up till now. Taxation is trying to take over that position, but I don't think taxation has fully taken over the position. Oil is one of the major sources of revenue for government, and as such, it is not something they can just joke with. So the administration, the regulation of the oil industry is very key. It is very, very key. Now, what do we need to do? Well, um, so for Petroleum Industry Act, I will not really be looking at the details about the act itself. Rather, I'll be focusing on how the act affects the taxation of companies engaged in petroleum activities. But that's what I'll be focusing my energy on. Then, if if need be, those are the two things we'll look at majorly. Then we might now that's why I've sent the material to you, at least up to a large extent. This material covers what is necessary for you to read. So we are able to look at this. We are able to look at this very well and maybe go through it again, go through the material just to have a good understanding of it. Then we can then say that okay, we have it, but so what we'll do is this: we'll just quickly go through personal income tax of why do I keep saying personal income tax? Sorry. We'll just quickly go through Petroleum Industry Act. My plan for today's class is that we'll most likely look at the theoretical aspect and do maybe some little calculations. Then if we by the time we proceed in the next class, we'll now most likely look at maybe 2 to 3 questions that that will that will cover what we need to do. That will cover what we need to do. So please let's make sure we go through all of these things, and I believe that God in his infinite mercy will bless our efforts with outstanding success. With outstanding success. Okay, so let's go straight into it. When we talk of the Petroleum Industry Act, the Petroleum Industry Act is not the first regulation we'll be having governing the um, governing the petroleum industry. However, to the best of my knowledge, we have diverse acts and regulations that are governing the activities of organizations or companies operating in the petroleum industry. Of which the one that affects us is the Petroleum Profit Tax Act (PPT). That's cap. I'm not so sure of it now. Cap P8 or so, or Cap P1 from 2004, which we normally adjust occasionally and do some stuff too. Now, in line with that act is what we used to do companies engaged in taxation of companies engaged in petroleum activities. However, that could no longer suffice the dynamism of the petroleum industry again, which is why we had to adopt another one. Now we have to adopt another one. Now the Petroleum Industry Act, in line with the Petroleum Industry Act, first thing first, two the Petroleum Industry Act, even though I think we have this before, yeah, divided the companies that are operating in the petroleum industry into three. You know, when we say oil and gas, everybody is doing oil and gas. I mean, oil and gas. Everybody will say, we ask this one, where do you work? Oil and gas. This one, where do you work? Oil and gas. This one, where do you work? Oil and gas. And if you now break down the oil and gas they are working, you will see that some of it are actually not oil and gas. We have some that are actually working in the oil and gas. We have some that are working in oil and gas. And we have some that are working in oil and gas. So for those that work in the likes of Shell, Chevron, Seplat, the Panocean and the likes, those are oil and gas. We have some companies that their whole work is to service the oil and gas industry. Like they do the services of their oil rigs amongst oil wells and the likes. Yes, they are also in the oil and gas. We have some that are in the business of transportation of crude oil. They are also in oil and gas. We have people that does the end part of it, the retail business. Those that work at the filling station, those that have filling station and sell the refined product. It's also oil and gas in one aspect. We have people that are selling palm oil and groundnut oil. It's also oil. It's also oil in one way or the other. We look at it. Hmm. So oil and gas is very much. However, the oil we are talking about here is not palm oil, it's not groundnut oil, it's not vegetable oil. We are talking of crude oil, and natural gas. And either we like it or not, especially for natural gas. Natural gas is here to stay in Nigeria, and based on forecast, Nigeria has enough deposit of natural gas that can sustain us for a long period of time. That I don't even think we've tapped up to 5% of the natural gas deposits we have in this country as of now. So gas is one of the avenue we can generate cleaner energy and cost efficient energy. So if you have interest, you can still tap into the gas market. Now, without wasting our time discussing all of that, the Act divided companies engaged in petroleum activities into three. We have the upstream activity, the midstream activities, and the downstream activities. For the upstream activities, there are those that are engaged in the exploration of the oil and the gas, those that actually does the digging of well, getting out the crude oil. Those are the ones we call upstream activity. Then we have those we call the midstream activities. Midstream activities are those that are engaged in activities like there are those that are engaged in activities like what's it called? In activities like drilling, transporting the crude oil,
Hi.
transporting crude oil from those that actually do the exploration to where it will be refined, and those that are engaged in refining activities. Refining activities is also under what's it called? Is also under midstream
Meet.
activity. Why downstream activities are those that do the down part of it. And then when I say down part, I mean parts like the not refining of crude oil, but I mean parts like selling the refined products, selling the refined products, um, selling refined products, selling refined products, doing oil and gas servicing, amongst other things. Those are the things we have under under what's it called? Those are the things we have under personal income tax, under downstream activity. I'm very sorry. Okay. Now, the provisions of this act are basically for those that are in the upstream activity, like I mean our discussion on taxation of organizations under the Petroleum Industry Act are basically for those in the upstream, because those are the oil and gas. Every other one is treated as a normal company and they will be subjected to tax under the Company Income Tax Act. Now, for upstream activities, for upstream operations has a commission that is responsible for the regulation of that industry. The commission is set up to regulate the activities of the upstream activities is what? Is the Nigeria Petroleum Regulatory Commission, NUPRC. NUPRC. That's the organization, that's its commission or the regulatory body for upstream petroleum activities. While for the midstream and downstream, they also have their own regulator, which is what we call the Nigeria Downstream and Midstream the Nigeria Midstream and Downstream Petroleum Regulatory Authority, NMDPRA. Yes, that's the authority. So for the agency responsible for midstream and downstream, we call them authority, Nigeria Midstream and Downstream Petroleum Regulatory Authority. While for the ones for the upstream activities, we call them commission, Nigeria Upstream Petroleum Regulatory Commission. Now, the way this thing works is that what? Now, for organization engaged in upstream activity, like I said, I'll not be going into the details of what the act is all about, but I'll just be explaining the key points that we need to know. Now, when an organization wants to carry out petroleum activity in Nigeria, you don't just say, you don't just get to field and start extracting crude oil or start exploring for crude oil. No, yeah, you don't just even as an individual. Let's assume I buy a land now, and I wanted to start work on the land. Maybe the worker has started work, they now realize that there is a mineral deposit on the land. Automatically, the moment they find mineral deposit on the land becomes that of government. The land is owned by the government. Then what do I now have? Government can now compensate me for what I have spent on the land and the likes. But before any company will now work on such land or carry out any exploration, they have to what? They have to take permission from government. The permission will be issued by what? The government agency, which we call the Nigeria Upstream Petroleum Regulatory Commission. Now, for them to permit you to do work on the land, you have to get what we call a license or a lease. The license or the lease is what gives you the right to work, and each license has where it can work and where it cannot work. Like now, we basically have 3 licenses or lease under the act. We have the petroleum exploration license, and it has its own limited rights. We have the petroleum prospecting license. It also has what it can do and what it cannot do. And lastly, we have the petroleum mining lease. The petroleum mining lease, that's like the highest cadre of the leases or of the permission. But that's by the way. So it seems I've mistakenly closed the material I opened that we'll be using for class. Okay. So now coming back to this, like I said, the rent, whatever they pay to get those licenses is what we call their rent. But that's not my whole main focus here. Now, in doing taxation of upstream activity companies, first thing first, we have to understand that organization operating in the upstream pays 2 types of tax. The carbon tax, which is mandated by the Petroleum Industry Act, and they also pay company income tax. That means we do 2 assessments for them. We'll assess them on hydrocarbon tax, and we'll also assess them to company income tax. The company income tax is not different from what we have discussed before. So our focus now will be on how do we go about computing hydrocarbon tax? Now, first thing first, it's important that we say that you say hydrocarbon tax, which is tax we pay on our petroleum operations only, is the tax is levied on petroleum, upstream petroleum in the companies, and it is paid on actual year basis. That is, you pay the tax in the same year you are making the income. You pay the tax in the same year you are making the income. Now, the tax is paid on an installment basis. So, how do we go about it? We pay the way we go about the taxes is that when when a year finishes now, let's say 2025, we have come to December. Yes, everybody can go home and sleep. But the companies that are engaging in upstream petroleum activities, they cannot go home to sleep. Why? Because between 1st of January of a new year to 28th February of that same year, they need to prepare what we call estimated returns. They need to prepare what we call estimated returns. The estimated returns, they will use it to file taxes. They will use it to file the hydrocarbon tax. What do we mean? They would have to estimate that, okay, what do we intend to make in the revenue this year? What do we intend to spend as cost? What do we intend to? So based on all of those things, they will now calculate what their hydrocarbon tax liability for that year should be. Then, once they calculate what it should be, they divide it by 12. They divide it by 12 for each one. Then they start making payment based on that estimated return from latest from 31 March of the year. Then they make payment every year till they get to February of the following year when they would have completed the 12 months payment. Then before 31 of May of that following year, we use 2026 as example first. By 31 March 2026 now, they must have started paying hydrocarbon tax for 2026. Anything they do in 2026 too, they must have been handing up by now. So now, they must have filed their estimated returns for 2026 and start paying. Now, for that 2025 that they have paid the estimated tax on up to February 2026, they now have till they have till May 2026 to complete the so they have till May 2020, the May of that year, the 31st May of the year following the year they carried out the operation to get the audited accounts, and they will now calculate what their actual tax should be based on the audited account. Then if there is an excess, then there will be a refund, and if there will be a refund or a credit. Then if there is no excess, then the company will have to pay the remaining balance. They will have to pay the remaining balance, but it must be paid on or before what? 31 May of the year. If not, it will be penalized for remitting late. Are we getting it?
Yes,
Hello?
sir. Yes, sir. We are with you.
Please
Okay.
help me summarize these dates again. The dates they have to make the revenue and just summarize it.
Okay. I see. For companies that are to pay hydrocarbon tax, which is upstream companies, they must have prepared an estimated account latest by 28th of February of the year. That is like this 2026 now, they must have prepared the estimated account for 2026, latest by February 2026. They filed out with the tax authority and they start making an installment payment of taxes based on the calculated estimate figure. They start making payments for the taxes every month, every year, latest before the end of the month. Now, but it's 12 months they want to use to contribute. And if they started by March, it will extend to next year April. Now say even though it extends to the April of the following month, we must by before 31 of May of that following month, the of that following year, sorry. What's it called? The audited account must have been ready, which will now show the true position of the entity. I mean, so with the true position of the entity information we now have, we can now go ahead to determine what is the actual tax liability of the company. When we now calculate the actual tax liability, if they have overpaid, then they will get a credit. But if they haven't, then they have to go pay the balance. Is it clear? Is it clear?
Yes, sir. Clear, sir.
Thank you.
Okay. Now, like we said, um, that's why the carbon tax. That's why the carbon tax. We'll still look at the illustration on it. Now, there's possibility that the estimate might be revised during the year. Maybe the sorry. Just know that the estimate can change during the year, and if the company notices that the estimate is changing, they can prepare a revised estimate, file it again with the tax authority, and continue payment based on the revised estimate they have shared. That's what they will start paying on. At the end of the year, if they haven't paid enough tax, they have to pay the balance. And if they have, then good for us. So that is what we have. What do you say? I really can't hear you.
I don't think somebody was talking now.
Okay. Okay. So we move to the next thing. Now, having shown that that is what we have about the carbon tax, there's also okay. Now, having said that about the um petroleum industry, then we can now focus on the next thing that we'll be doing. Now, the next thing would be determining how to go about the computation of the tax liability. But before we do that, let's quickly do an illustration on what we did, what we just explained now. You can go to the last page of the material. Let's quickly read question 5 and see what we can do with it. Are we done reading? Don't tell me nobody read though.
No. The last page is
The
it this part?
question was not showing from your end, so I'm trying to know where the question is coming from. I think that's why nobody is reading for now.
Are you saying you guys can't see my screen?
We can see your screen, but
No
what we are seeing
question.
here is
What you are seeing there is what?
Agro Limited completion
This
of
was
tax.
double taxation relief.
And it's
Is the
coming.
working of
My
Double
Ghana
taxation.
Limited.
You guys would have thought that I'm not projecting the material. But if I'm explaining this material, I would have projected normally now. Yeah, can someone read?
It's
It's
not
still
up
not
yet.
showing.
it's
It's
not
showing computation
showing.
of tax liability for 2022.
My
And this
gonna
Okay, I think the WhatsApp group should give us
and it's showing
and
that
the
we are
person, if you
yet
look
to
at the,
having some issues.
can you hear me?
okay.
Yeah, we can see
Question
it.
what
We
she did.
can see it.
Question what?
Uh-huh. It has come up.
Let's say
He
the
said
last
question 5.
Okay, we can see it now, sir.
It's showing now.
Please, you guys should read though. If I still pause
Banda
while waiting for
employee
you to read,
Banga Exploration and Production Company Limited has been operating in Nigeria for a while and filed its 2025 tax estimate on February 2025. Due to operational dynamics, the estimate were revised in July and November of the same year with the following returns: February 2025 initial estimate $720 million. July 2025 first revised $428,000 $428 million. November 2025 second revised $510 million required. Determine the monthly hydrocarbon tax payable based on the annual estimate state above. B. If the actual HT for 2025 accounting period is $542,150,225, compute the 13th installment payable, if any. C. What is the due date for filing HT estimate? D. What is the due date of payment of the 13th installment?
Are you done?
Yes, sir.
Yes, sir.
So we have Bonga Exploration Company. Okay, so what do we have? We would say that to determine the monthly hydrocarbon tax, determination of monthly hydrocarbon tax. So the monthly hydrocarbon tax will be, since the first estimate or the initial estimate was in February 2025, that will cover what they will pay from March. But because there was a revision in July, that means that first initial estimate we have would have only covered what they will pay from July to when? From March to what? June. From March to June. And how much is it? We'll say $720 million divided by 12. So that will be divided by 12 months. And how much will be the hydrocarbon tax? That should be 60,000. Am I right? 60 million, sorry.
Yes, sir.
60 million. Now, the moment the first revision is done, what do we say will happen? We'll have to revise what our tax liability will also be. So, our tax liability will now be, for July, there was also another revision in November. That means this will only last us till October. So now be what? The 720 million, sorry, the 428 million minus what we have charged as depreciation before, 600,000. Sorry, minus 600 million multiplied by how many months have we paid for already? We have paid for 4 months, have we? Which is March to June. March, April, May, June. That's 4 months. So that will now be 12 divided by 12 minus 4 because they've already paid 4 months. So the remainder will only be spread by to how many places? To 8 places over the 8 remaining months period. What do we have? So what do we then have? This will give us what? Oh yeah, figure.
Sorry.
You don't need to put all of the figures on your calculator. Just do 428 minus 600 times 4. 600 times.
Sorry, I can't.
No, 60 million. Sorry, this will be 60 million, not 600 million. So 60 million times 4 will give us 240. So 428
Divided by
minus
8.
240
Yes.
divided by 8.
That's
So that will give us 23,000.
15.6 million. Let's say
15.6
15.7.
million. Onígbó, onígbó, ibo ló ti rí yẹn?
Ah,
Well, so is it supposed to be a month or a year? Just asking me.
It is these figures they are giving us, this 720 million is for 1 year. To now know what they are to pay for 1 month, we have to divide by 12. Is it clear?
okay, sir. At
Okay.
least at 23.5. I did not pay attention to the 4. I'm supposed to subtract the 4.
So
Am
what
being
are we supposed to do? We'll have what? Based on the second division, the tax liability should now be 510 million. But of this 510 million, we've paid 60 million. 600 million, 60 million. That's one thing about this topic. We'll be calling huge figures. 600 million multiplied by 4, minus what? 23.5 million multiplied by 4 also. We've already paid all of this, so we can't be paying it again. Then we now say divided by 12 minus what? 8, because from March to June is 4 months, July to October is another 4 months. So this will remain what? 4 months. And that will give us what? That will give us what?
44.5. That's 500,000.
44,500,000. So those are what will be the monthly hydrocarbon tax based on the annual estimate. For March to June, they will be paying 60 million monthly. Then for July to October, they will be paying 23.5 million monthly. Then for November to the following year, February, sorry, not March, it's February because that's when the 12 month elapse. Okay, so that's that about that. That's for A part. For the B part, what did they ask us to do? They said if the actual CIACT for the year is 542, we should compute the 13th month installment. So we say computation of 13th installment. Computation of 13th So computation of 13th month installments. So we say actual hydrocarbon tax 542,150,225. Then we can say less recoverable amounts. So sorry, we'll say less estimated ACT. What is our estimated ACT? We have estimated ACT to be what? 510,000. 500 and what? 10, sorry, 510 million. And that will give us what? So how do I know it is 510? Since 510 was the last estimate, and that is what their payment was based on, that's what it should have been. But just to be sure or confirm, you can do 60 million times 4 plus 23.5 million times 4 plus ACT multiplied by 4. Are we getting it? So this will give us 32,150,225. That's the 13th month installment that they will need to pay. And when do we say they will pay this thing? They must have paid it. That's the 13th installment. Now, they say when is the due date for filing ACT? The due date for filing is 28th February or the last day of the month. Are we getting it? Then due
Yes, sir.
date of 13th installment, the due date for that is what? 31 August. 31. The due date for filing hydrocarbon tax is what? Is 21 of
28th of
the
March. I think it's 28th March. February, sorry.
24th. But they now ask what is the due date for payment of 13th installment? It is 31st of May. The due date is 31st May. But the goods of your customers that they have kept in the compound is their responsibility to keep watch over that. Okay, so that is that one. That is that on this. So any other workings before we call it a time?
Sir, please can you come again with the C and D?
So the C, they're asking us what is the due date for filing hydrocarbon tax estimate. The due date for filing is 28th February, and the due date for the payment of the taxes is the last day of each month. While the last one, they ask for what is the due date of payment of 13th month. Due date for payment of 13th month is 31 May. By 31 May, they must have done anything they want to do and what? And put their vendor in their account. So that is that on. That is that on that. Is it
Okay,
clear?
sir. Yes, noted, sir. Please, I have a question on this last figure we did. On the November to February 2020, this thing, the 510 minus 240 minus 94. What I'm getting here was 44 million, not 44 million 500. So I don't think, I guess someone should also confirm so we can be sure.
Okay. Any other question? Hello?
No,
Hello?
sir.
My
I think
question, sir, is
sir.
that due date for filing estimate? I didn't hear you well. I think it's because
The
of
date
network.
for filing estimate is 28th of February of the year, of that year that they are paying the hydrocarbon tax for. But
Okay.
the due date of payment of the
Okay.
hydrocarbon tax estimate is the last day of each month, 31 of March of the year to 28th of February of the following year. While the due date for paying the 13th month installment is 31 of May. Is it clear now? Is this clear now?
Yes, thank you.
You're welcome. Okay, we are getting there gradually. We are getting there gradually. Having looked at this, we move straight to the next thing. How do they now do that estimate that they are do that we are once talking about? How do we go about it? Is what we want to look at. Now, in the computation of hydrocarbon tax, there are some things that doesn't go the way we are used to, like under what is it called? Like under Petroleum Industry Act. So we'll have so let's first talk about computation of capital allowance. Under Petroleum Industry Act, capital allowance is not computed as an initial and annual basis like we have under company income tax. Rather, there is no initial allowance, we only grant annual allowance, and the allowance is at 10%. The allowance is at 10%. Sorry, the allowance is at 20% in the first 4 years of the asset, then 19% in the fifth year, after which the asset will no longer enjoy capital allowance disposal. Are we getting it? What do we mean by this? I don't know why students confuse this information. When we say it is granted 20% in the first 4 years of the asset, I'm not referring to the year you are assessing. I'm referring to the year they purchase the asset. So when I have any question, let's assume in a question I'm assessing for 2025, I know whatever I'm doing, I need to know what is the value for that thing in that 2025. So I'll go check when did they buy this asset that they gave me in this question. If the asset was bought in let's say in 2023, I'll say okay, 2023 asset bought in 2023. 2023 is the first year of that asset. 2024 is the second year of that asset. The 2025 I want to work on is the third year of the asset. So it's still within the first 4 years. It will enjoy tax at 20%. But if that asset was bought in 2025, 2025 is still in the first year. It's within the first 4 years, so it will enjoy at 20%. If that asset was bought in year 2021, I'll say, okay, 2021, first year, it would have enjoyed at 20. 2022, second year, it would have enjoyed at 20. 2023, third year, it would have enjoyed at 20. 2024, fourth year, it would have enjoyed at 20. The 4 year period has lapsed. 2025 that I'm computing for, the asset is in its fifth year, so it can only enjoy at 19%. But let's assume the asset was purchased in 2018. 2018, first year, 2019, second year, 2020, third year, 2021, fourth year, 2022, fifth year. Still, year 2025, the assets can no longer enjoy capital allowance because the 5 year window period has passed. So anything after that 5 years, the assets can no longer enjoy capital allowance. So the best way company manage that is that once the asset is up to that period, they sell it off and buy another one so that they can continue enjoying capital allowance. Is it clear? Is it clear? Any question? Hello?
Hello, sir. Good evening, sir.
Eh?
No questions from my side, sir.
Okay. So let's look at a short illustration on that.
Okay, sir.
So yeah, who is reading? Illustration one.
Sorry, I can't see your screen, sir. Okay. I can't see your screen, sir.
Is it only how everybody? Is she the only one that cannot see my screen, or is everyone that cannot see my screen?
I can see the screen. I can see um
Oh yeah,
illustration
yeah,
one. Let me
please
read.
read question one. Yeah, I mean, you can log off and rejoin. It will be your network.
The following information was extracted from the account of Rema Oil Limited for the year ended 31st December 2023. We have plants, machineries. Calculate the annual allowance for 2023 year of assessment. That's all.
Okay, you can see that's a very direct question. No, no too long talk.
Yes, sir.
So we'll say, can you see the screen now?
Yes, sir.
Welcome back to class. So we are to do this. We would have what? Raman Oil Limited. Computation of capital allowance for 2023 year of assessment. So we'll have year of acquisition, we'll have the QCE, we'll have the value, we'll have the capital allowance rate, then we'll have capital allowance amounts. So what do we have? Year of acquisition 2019. QCE is what? Plants and machinery. Okay, the value is 18,900. This one was acquired in 2020. Tangible dealing cost 17,600. 2022 pipeline and storage tanks. 19,000. 2023. We have what? Building. 15,400. So because we are doing for 2023, for an asset to enjoy capital allowance at the rate of 20% in 2023, that asset must have been bought between the first 4 years. The first 4 years must fall in 2023, Abi. That means if the asset, okay, don't let me go down so it will not be confusing. For the first asset that was purchased in 2019, 2019 would have been the asset first year, 2020 second year, 2021 third year, 2022 fourth year, 2023 that we are computing for is the fifth year of this asset. So the capital allowance rate will be 19. Tangible dealing cost was acquired in 2020. 2020 is the first year, 21 second year, 22 third year, 24 fourth year. So that means it will enjoy at 20%. 2022 is when they acquired the next asset. 22 still at 22 is still in the in 22 first year, 2023 second year, so it will still be at 20%. Building is just acquired, so it's still at what? 20% because it's in its own first year. So what will this give us? Figure, please.
That is 19% of, sorry, 19% of 1900. That's
That
3591.
3,591.
20% of 17,600 is 350.
Three what?
3,520.
Please confirm the remaining figures are correct and give me the total.
Yeah, 17,600. 350.
Ah, Mr. T, Mr. T, Mr. T,
I've seen it.
better, better, better. But do we all understand? Hello, yeah, give me the total. Oh. Hello. Ah, Ọlọ́run, ẹ ti
Okay,
dìbò.
sir, we are with you, sir.
Give me the total now. Ah,
You're punching it.
I'm punching
Five,
what? If I using my calculator, I would have forgotten I
five.
think I did this question. Then tell
Okay,
me,
13,000.
as you get your last
13,991. 13,991.
13991.
13991. Ẹ fẹ́ gbẹ̀mí mi sí látẹ̀kùn. That's on computation of what is it called? That's for computation much on it. The next thing we'll be looking at how we compute it is what we call production allowance. What is production allowance? It's an allowance that is granted to companies engaged in petroleum activities for their operations. It is an incentive. We use it to reduce the chargeable profit of the business. We use it to reduce the chargeable profit of the business. and and what am I saying? The production allowance is calculated on the volume of output and to date, and the rate at which you calculate it is a bit is a bit technical. Where an organization has carried out their exploration activity in an onshore area, then the production allowance will be for what? Will be at the lower of 8% per barrel or 20% of the fiscal oil price for the first 50 million barrels. However, after that, any barrel they do after first 50 million barrels, the 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 allowance will be $4 per barrel or what? 20% of fiscal oil price or 20% of fiscal oil price, whichever is lower of the two, is what would is what would do. Is what would take to be the petroleum allowance, or we call it production allowance, we also call it petroleum allowance. If it is shallow waters, 100 million barrels we do that for, then anything above 100 million barrels. Then for deep offshore and frontier basin, we do at lower of 8% per dollar times the uh, and the low and 20% of fiscal oil price times the 100 million barrels. But um, no, sorry, for deep offshore it is 500 million barrels. First 500 million barrels. Then any other thing after that would be at lower of $4 per barrel, 20% of fiscal for production allowance. However, before we do illustration on production allowance, it's also important I explain what fiscal oil value is. Fiscal oil value, you see, the petroleum industry doesn't work anyhow. It doesn't work in isolation. Rather, they are governed directly. They are really governed. The security around them is very high. Now, um, now what we call fiscal oil value is the value we would have gotten from the value we got from from the what's it called from the crude oil sold from the crude oil sold. That is what we have. Sorry, fiscal oil value is just the fiscal oil price. You know, prices for petrol or for crude oil is not determined locally. It's not as if it's our people that is determining it. It's the international market that is determining it. So when we have the price, sorry, maybe when we have the price, we'll do more. Okay. So to get fiscal oil value, we just do fiscal oil, and go back to sorry, that's that. So this 125 you are seeing here now is the price. While once we use that to multiply the volume they do to give us the value. But that is that on the side. So can someone go take us to illustration 3?
Required.
What do you say?
Required. Calculate.
Illustration.
Required.
I think it's
Compute the fiscal value of crude oil sold for 2023 year of assessment. Compute production allowance for 2023 year of assessment. Pillar Oil Upstream Petroleum Company Limited was established several years ago, and the following data for crude oil production for the year 31st December 2023 is provided in the scheduled below. Area of operation area of operation prior years cumulative production, current production, total cumulative production. Onshore 53 million barrel, current production 7.5 million barrel. Sorry, okay, all figures are assumed correct. Subhanallah. Sorry, I can't see the screen again.
I'm not that's from your network. Oh.
A, it should be noted that the fiscal oil production advised by the Nigeria Upstream Petroleum Regulatory Commission (NPC) is 125 naira per barrel. Then B, the company dispose of oil, oil, the oil, the crude produced in the current year of the fiscal price advised by the commission required. Compute the fiscal value of crude oil total sold for 2023 year of assessment. Compute the production allowance for 2023 year of assessment. I think that's all. Hello.
Sorry, sir, we can't hear you, sir.
Okay, let's take it one after the other. Can you hear me?
Yes, sir.
Hello?
Yes, sir, I
So,
can hear you, sir.
so we have Pillar Oil, Upstream Petroleum Company. Then what do we have? The first thing we are asked to compute the fiscal oil value, the fiscal value of crude oil sold for 2023 year of assessment. To do this, I would say area of operations would bring the current year production. Current year production. You bring what? The fiscal oil price. Then that will give you the fiscal oil value. For area of operation, which is onshore, the current year they did 7.5 million barrels. Abi?
Yes, sir.
Okay. Shallow water, they did 35.75 million barrels. Deep offshore, they did 47.2 million barrels. So here, they did not give us different prices or different types of crude oil. They just say the price advised by the upstream is 125. So since they did not separate it, they just say 125, 125, 125. Now, since also did not give us exchange rates and all of that, we will not bother ourselves. We'll calculate it in dollars and leave it for them like that. Are we getting it? Figure, figure.
There's no
Would,
light where I am, so I can't see calculator. So I can't see the screen. I'm inside the dark place.
Okay. So,
I'm not using
um,
laptop.
we have 7.5. Okay. 7,500,000. 7,500,000 times 125. So we have 937 million. 937. Oh, sorry. So we have 47.2 times 125. That's 59 plus 1468.75 plus 937.5. 11,332. That's correct, sir.
so the next thing, which is our main focus here, is computation of production allowance for 2023 year of assessment.
Sorry, Goodwill, the way you did this fiscal value, we can quote it like this in the during the exam, abi?
Yes, now you can
The
always quote it.
millions.
Yes, you can always quote anything in exam. So far you have quoted it well. Nobody will penalize you for quoting.
Okay, thank you.
Even I can do quote their figures now, don't they? Okay. To get the um to get the what's it called? We'll say onshore operation. Now for the onshore, the accumulative production is 60.5 million barrels. So we'll say for the first 50 million barrels out of it, first 50 million barrels, lower of $8 per barrel. That will be $8 times 50 million barrels, or 20% multiplied by fiscal oil price, which is $125 here, multiplied by the 50 million barrels. Then the remainder, which is the next 10.5 million barrels, that will be at lower of $4 per barrel. That will $4 times 10.5 million barrels,
Okay, 10.5 times.
or 20% of fiscal oil price multiplied by 10.5 million barrels. For shallow
42.
waters, huh?
42 lower of this one is 42 lower of $4 and 10.5 million barrel.
42, The second one,
The second one is, please give me some time to do that one.
so for shallow waters, what we have there is first 100 million barrels. First 100 million barrels. And we have a total of 127.75
60.
million barrels here. So we'll say lower of $8 per barrel, that's $8 times 100 million barrels, or 20% of $125 multiplied by 100 million barrels. Then the
262.
next what? I'm coming on. Next 25.75 million barrels. That will be at lower of $4 per barrel times 25.75 million barrels, or 20% of 125 of 25.75 million barrels. 260 what? Which one are you giving me?
The second one, next 10.5 million barrel, the second one,
Is
or
what?
that one, that is the 262.5.
262.5. Since you are picking the lower between the two,
Then the
we pick the
the first
second.
one onshore.
How
Okay,
much?
sir. Sorry.
How much is the onshore? The $8 per barrel.
The $8 per barrel is 40.
40 or 400.
1250. 1250.
40 or 400?
It's 40.
8 times 50 is 40.
400.
400, sorry. It's 400, sir.
Uh-huh. So the lower is 400.
400, sir.
Okay?
Yes, sir.
So having done that, for the deep offshore,
82500.
2005. So the lower there is 800. Uh-huh.
That's 103. 103 and 64.
Sorry. Just
That's
saying.
103 and 643.75.
Huh?
103. 4 times 25.
103. Uh-huh.
643.75.
Hmm?
643.75.
So the lower here is also 103.
Sure.
So we move to deep offshore.
20%, 125, 20.
I'm not getting you. I'm not. For deep offshore, we'll have first 500
5.75. This
million
second one
barrels.
is 128.75. Okay, 103.
I'm not getting you. So we have lower of $8 per barrel times 500 million barrels, or 20% of $125
That's 4,000, sir.
of 500 million barrels. Then we now say next, what? Out of 947, we've done for 500 million to remain 447.2 million barrels. We'll have what? Lower of
12.5, yeah.
$4 multiplied by 447.2
Oh,
million barrels, or 20% of 125, then multiply by 447.2. What do we have?
12.5.
Huh?
Deep offshore. Okay.
Oh yeah,
For the deep offshore, the lower. Next 447.2 barrel. The lower is one 11,181.
the last one,
Yes, sir.
111,185.
108. Yes, sir.
Uh,
1,788.8.
so if that is the case, we are picking the lower in each scenario. So we are picking that 1788.8, and we have 4,000. So the summation of it all will be what?
178 plus 4,000.
Now it was 7,133.8. Is it
Yes,
clear?
sir. Yes, sir.
Should we proceed? Should we proceed or call it a time?
I I don't know, sir.
Okay, so the next thing we have is okay. So the next thing we have is royalty.
Mr.
Royalty.
Chitubim, should the class proceed?
No, worry, the class is continuing. Okay, so the next thing is this thing.
Sorry, sir, I cannot see your screen.
It's your network. Are we there?
Yes, sir, I can see your screen now, sir.
Okay, so so the next thing we have is royalty. Royalty is also one very important concept in taxation. Just like we said that the crude oil belongs to government, and governments are the ones that will determine what should be done, to what extent, and everything about the use of the crude oil. And governments, um, sorry. Now, when a company has done their exploration, they have to pay royalty to government. Now for royalty under the PIA, royalty is charged on two bases. We charge royalty on production basis and we also charge royalty on price basis. You see, for production, it is a bit simple. It's a bit simple, just that you have to know the rate. If you don't know the rate, it can become an issue for you. So what do I mean? This is the royalty table as prescribed in the Act. So how do we now? So you now look at what is their area of operation and what is their area of operation, and then what is their volume per day. That's what will determine the royalty rate we will give you. So if it's an onshore operation now and they are producing above 10,000 barrels per day, their own rate is 15%. If it is shallow water of up to 200 meters water depth and they are producing more than 10,000 barrels per day, that will be 12.5%. If it is operations in territorial water and continental shelf area between 100 and 200 of water depth, it is the same, above 10,000. Use the 12.5%. Operations in territorial water and continental shelf beyond 200-meter water depth, if it is between 1 to 50,000 barrels per day, 5%. If it's more than 7.5%. So we also have the completion here. If it is onshore fields and shallow waters, including marginal field, if it is 1 to 5,000, then the rate will be 5%. While if it is between 5,000 to 10,000, then the rate will be 7.5%. 7.5%. So that's what this thing is all about. Okay.
Sorry, I cannot hear you, sir.
Sorry. Okay, so that's for royalty based on production. For gas, the location of sales is what determines what the royalty should be. If this thing, if it is sold locally, then 2.5% is what we charge as royalty. But if it is sold in the export market, 5% is what we charge as royalty. But you see, royalty based on price. Royalty based on price. We'll do what? We'll have to the act provides for this thing. Tells us that when we are if the price is $50, if the price is below $50, if the price is below $50, if royalty is below $50, then the royalty rate is 0%. If it is between 50 to 100, then we have to do linear interpolation. If it is above 100, if it is actually 100, the interest rate will be 5%. Okay. So if the price is above $100 to $150, there is a linear interpolation method we use for that also. And if the price is above $150, we charge 10%. Or let me say if it's at exactly $150, we charge 12.5% dollars as the revenue. Is it clear? Hello?
Yes, sir. When we go through it will become more clear, sir.
Huh?
I'm following, sir.
So that is that. For the linear interpolation method, we use the formula higher price minus lower price divided by higher price minus actual price, which is equal to higher cost minus lower cost divided by so divided by higher rates, let's use it over higher rate minus actual rate. So depending on what the this thing depending on what the fiscal oil price is, because it's the fiscal oil price we are trying to get to know what the rate will be. So let's assume the fiscal oil price is $85. Then $85 is between what? Zero to is between 50 to 100. So we'll use your own this thing. We'll have what? Higher price will be $100 since it's between 50 and 100, minus lower price, which is $50, divided by higher price $100 minus what? Actual price, which is what? $85. And the difference will be what?
The difference. Sorry.
The higher rate will be what? At
$50.
$100, the rate is 5%, while the lower rate at $50 is 0%. At higher rate is still 5%, but actual rate is what we don't know. So what do we do? 100 minus 50 will give us 50. 100 minus 85 will give us 15. That will give us
50.
5 minus 0, 5
5.
divided by
5 minus X.
okay.
Oh, sorry, sir. Why does the percentage down as 5x?
Because we don't know
5x.
what the actual rate is. It's the actual rate we actually want to calculate now.
Okay.
So we then cross multiply. So that will be 50 into bracket 5 minus x. You know I will be in class by now. Okay, equals to what? Equals to 75. Abi?
75. Okay, 15 times 5. Yes.
So that will give us what? 50 times 5. That will give us 250 minus
250
50x
plus
equals to
minus
75.
50x. 75. 250
So
minus
250
7.
minus 75 equals to 50x. X will be equals to what?
175 divided by 50.
175 divided by 50.
Divided by
X will be
50.
equals to what?
3.5.
3.5%. Is it clear?
Yes, sir.
Okay. So, but if the price is, let's say, price is $120, $120 would have been between the range of 150 to $100, abi? Then this will be 150 minus 120, which will equals to what? 10% minus 5%. Okay, what do we have? This will be 10
minus x.
minus x. So this will give us 50 over 30 equals to 5 over 10 minus x.
10 minus
And
x.
that will be 50 into bracket 10 minus x equals to what? Equals to 150. So 500 minus
Yeah.
50x equals to 150. 500 minus 150 equals to 50x. X came what? 350 divided by 50.
50.
And that will give us how much?
That'll give us 7.
7%. So this rate we have calculated is what we'll now use to multiply the fiscal oil value to know what our royalty amount will be. Is it clear?
Yes,
Do
sir.
you understand?
Yes, sir.
Okay. So that is that on that. So let's now look at um let's compute what is it called? Hydrocarbon tax for that illustration we did earlier. For this illustration, I said hydrocarbon tax. Let's compute royalty for it, after which we'll call it a time. So to compute
Okay, sir.
royalty for this, we can either do royalty based on price or royalty based on production first, but you have to do both. So let me see, do I still have space? Yes, I think I can still manage the space I have here. Or don't you think I can manage it?
Okay, sir.
So I want to compute for $125, which is the price here. $125 will be 150 minus 100, abi? 150
Sorry, sir.
minus 100 equals to what? 10% minus 5% divided by what? 150 minus 125, which means this will be divided by what? 10% minus x. So that will give us what? 50 over 25 equals to 5 over 10 minus x. We cross multiply, we'll have 50 into bracket 10 minus x equals to what? 5 times 25.
That's
125. So that will
125.
give
Yeah.
us 500 minus
Okay.
50x equals to 125. Okay? So that means we'll have what? 500 minus 125 equals to 50x. X will be equals to what?
Um,
375
to 5
divided by
divided by
50.
50.
X will give us what?
X will be 7.5.
7.5%. So let's calculate the royalty. So computation of royalty based on price. Let's do that of price first. So we can just say area of operations we have area of operation, we have aside area of operation, we have we can put the current year production there. We can put the amounts, the value.
Sure, it's not on the screen. It is a formal question that is on the screen. The computation of production
So
allowance.
the
The royalty
royalty,
question is not on.
yes, it's that same question we want to use to calculate royalty.
Okay.
Royalty amounts. So if we are to do that, we'll have what? Onshore 7.5 million barrels. But in this life, what do we have?
We have
937.5. Shallow waters, shallow waters. They did 35.75 million barrels. And that gave us how much?
also 4,400
4,000,
and
4468.75. Then deep offshore, 42, 47.2 million
point
barrels.
7.2 million balance.
That's 5,900.
But actually, our amount
The fiscal oil
based on
value we
that
calculated
lower
earlier.
production allowance, lower rate.
Fiscal oil value that we calculated earlier.
Okay, okay, okay.
So if that's the rate, the royalty rate we calculated is 7.5%. So 7.5% multiplied by those amounts, what do we have?
okay. Sorry. 1 minute. 7,031.25 for the onshore,
7,000 and
31.25.
now what are you doing? You are calculating 0.775, 7.5% of
Sorry.
937.5.
Sorry,
That will
sir.
give us 70,3125. So because we are approximating in dollars, that's why we are having 70,3125. But it's points we have there.
Okay, sir.
Okay, for the second one, we'll do 4468.75 multiplied by 8. What do we have? three five. Okay, the last one
292.5.
292.5. Are you sure it's 292.5 or 442.5?
Let me confirm, sir. Sorry, sir. Mm, 292.5, sir.
Is what?
292.5.
Is what? What does 292.5 represent?
The amount for deep offshore.
Impossible.
Total you are talking about royalty amount.
5,000 times 7.5%. How can that give
Is
you
that
290?
59, sir? Sir, is it
Yes,
59 or
now
39?
390. It's 59 now.
Okay. Okay, sir.
So the summation we have 847 96875. That's for royalty based on price. We have to do royalty based on production, computation of royalty based on production.
The question is to come out. The way we involve loyalty in this question when it's not part of the question. How do we go about it, sir?
I'm just using this to explain. No examiner has
But
even
in
has ever
another
even tested.
exam atmosphere, how will
If
the
they
question
need
sound
to
like?
compute it, they will state it that you should compute it. It's not this thing. In most cases, they would have given you all of this thing that we are computing. I'm just showing us if the examiner say calculate it yourself, how you will go about it. So the current year production, the production per day, the amount, the royalty rates, then the amount. So we have onshore, shallow water, deep offshore. So the current year production was 7.5 million barrels, 35.75 million barrels, and 47.2 million barrels. So what do we have as a production per day for each entity? You know, you will be dividing it by what? You will be dividing the production by what? By 365 days.
Okay.
So this will
That
give us
is
25 what?
60 point.
2548 in one day.
Alright. Okay. Sorry, is it production? The production we are using, is it the 60.5 million barrel or
No, the
7.5 million
current
barrel?
year production. Current year production.
Okay, sir.
Okay. So having gotten that, what are the amounts? 937.5 million, 4468.75, and 5,900. So the royalty rate, like I said, we'll have to check the royalty table. So because onshore operation is doing more than 10,000 barrels per day, the rate will be 15%. Shallow water is also doing more than 10,000 barrels per day, their own rate will be 12.5%. Then lastly, deep offshore is also operating what? Okay. So deep offshore is the one we have here beyond 200-meter water depth. That will be what? 7.5% because they are doing more than 50,000 barrels per day. So what would these figures give us?
Sorry.
140,625. Okay. 558. 59375. Then what else do we have? This will be 442,500. So the summation of all this will give us what? Okay, that will give us what? Is no one calculating? One 1141.71875. So their total royalty for the year will be what? 1,141,718.75. Total royalty will be 1141 plus that one we have up there, 847.96875. So our total royalty will be what? 1989. 6847. 687.47. So that's our royalty amount. That's our royalty amount. And that will be all. Okay, so that will be all we'll be doing for today. In our next class, we'll proceed with other adjustments. We'll be explaining the allowable and disallowable expenses, and God's willing, we'll look at few more illustrations before we call it a time on Petroleum Industry Tax Act.
Thank you, sir.